Welcome everyone to Vested Interest. This is Shane, and before we get into the video, I'd like to take a moment to thank everyone who's taken the time to watch, comment, and like the videos, and a special thank you to those who subscribe to the channel. I really do appreciate it. The channel continues to grow because of people like you, and if you have been lurking out there in the shadows and have not hit that subscribe button yet or that notification bell, go ahead and do that. Take a moment. It doesn't cost you a thing. It really helps out a small YouTube channel like me grow. And the YouTube algorithm counts on a few things: you watching the videos, you liking the videos, you hitting that subscribe button, and hit that notification bell so you're notified whenever we put out any new content. We are going to take a look at 5 stocks to buy in September. These are 4 stocks that I own currently and 1 new one. We're going to take a look at Realty Income, CVS, Valet, Enbridge, and the new one would be Haverty's Furniture. I'm looking for more of a pullback here, but let's talk through it as we go into the video. And for those of you who may be stopping by for the first time, it's not rocket science. In my opinion, the best way to do anything, keep it as simple as possible. So it really boils down to consistently investing, buying dividend growth stocks. That's what we do here on this channel. We cover dividend growth stocks. We buy dividend growth stocks on a weekly basis. I have a portfolio update video series that I do every Sunday morning, so check that out if you're into seeing how an actual portfolio is built out over time. I also do a series Monday through Thursday, stock pick of the day series. Look at a stock that's pulled back on the day to see if there's any potential value there. Videos like this as we head into a new month. I'll do the stocks that I'm looking to buy in the month coming up. So I'm recording this actually on August 31st, the last day of the month, and I will put this out September 1st in the morning before the market opens so that you can see what I'm looking to buy here in the month of September. And I'll also cover the dividends paid out for the previous month here, probably coming out Saturday, so look out for that video as well. Again, hit that subscribe button, hit the notification bell down below, and join us here in the Vested Interest community, building a community of like-minded dividend growth investors to do exactly what we're doing here. Share the stocks that we're watching, our experiences overall as investors. We can learn from each other along the way. So let's jump right in and take a look at these 5 stocks here. So this is the Vested Interest Stock Screener. This is also how I set up my Stock Pick of the Day series here, right? Understand the business, growing free cash flow over the last 5 years and expected in the future, growing dividend over time, dividend payout ratio of 75% or less. This does not apply to REITs or BDCs. They typically have a higher payout ratio. REITs, for example, have to pay out at least 90% of their free cash flow to maintain their status as a REIT and the tax implications that are associated. Check valuation based on dividend yield theory. This is a quick gauge to see if a stock is potentially undervalued or overvalued. To do that, you look at the current yield. If it's above the 5-year average, that would be potentially undervalued. If the current yield is below its 5-year average, that would be a hold, potentially overvalued. And if the current yield is equal to the 5-year average, that would be fair value. Buy below my current cost basis or within 15% of the stock's current 52-week low. I look at the return on invested capital, return on equity equal to or greater than the industry average, or 10% or plus. I really like 10% or plus. And earnings per share growth equal or greater than the industry average, or 5% plus. And for financial companies, I throw in price to book. You can really use price to book for any company, but it really is applicable for financial companies. 1 being fair value, anything over 1 being overvalued, anything under 1 being undervalued. And for other companies, you might want to compare them to their industry average, right? Sometimes price to book, the 1 is not for financial companies, yes, but for other companies, it might not necessarily be 1. It might be a 5, might be a 6. You want to compare them to their industry average there. And for me to be interested in taking a deeper dive going into the financials of the company, it must meet 5 of the 8 to be investable. And if it's a financial company, it must meet 6 of the 9 I add in this price to book. So now we'll turn it over to the very first stock we're taking a look at, CVS Pharmacy. This one continues to fall here. And these numbers are all as of the close of business on August 31st, so last day of August. These close of business here, that'll be all the numbers that we see here when I put this together. So they closed out the day down 2.48% on August 31st, $65.17. We are talking about CVS Health Corporation, ticker CVS, out of the healthcare sector. They have, according to Yahoo Finance, where I pulled this information, a near fair value, so 7% estimated return. So they are under fair value currently, according to them. They have a 52-week range $64.62 for the low, $104.83 for the high, definitely closer to the 52-week low, and that's where I like them. Within 15% or right up against their 52-week low is where I'm interested in these companies. Average value, we're setting a new 52-week low. Average volume 9.3. We don't really need to go into that, but market cap 83.704 billion, a beta of 0.61, so it is less volatile than the overall market. PE ratio is elevated on this one. Price to earnings $29.76 per share. EPS, earnings per share, is $2.19 per share. Next earnings date, October 31st or through the November 6th, sometime in there. For dividend, $2.42. They are a quarterly payer, and they have a nice dividend yield, 3.60%. Ex-dividend date was July 20th. We'll look over here. Looks like they paid out August 1st, so you would be in line for the next dividend if you bought them now. And a one-year target estimate, at least according to Yahoo Finance, of $91.56. So they see some upside appreciation on this one for sure. This is really for traders, but you can see here, bearish pattern detected, they're calling it. In the short term, they're seeing it raise a little bit. In the mid and long term, they see it going down, right? So that drop off throughout the day on August 31st. Now, dividend yield theory, 5-year dividend yield is 2.81. It's currently sitting at 3.60, so it is much higher than their 5-year average. So that speaks to some potential undervaluation on this one. Payout ratio is elevated, 105.48, though whenever I looked at another source here, stockanalysis.com, this payout ratio is high, reported out from Yahoo Finance, but that is not what's being reported out from stockanalysis.com. So I would back check this, and I always recommend more than one source so you can back check the information is accurate. Now, this is from stockanalysis.com. I like to look at return on equity, ROE, and return on invested capital. I usually like 10% or greater, but for this company, these numbers are just fine. Return on equity, 4.1%. Return on invested capital, 5.7%. You'd want to compare them to like a company like Walgreens, Rite Aid, those companies, and they are all below 10% return on invested capital. It's just the nature of a retail stores like CVS here. Free cash flow is when you want to get into financials. Look at their balance sheet, their income statement. If you're ever interested in a company, you want to do more of a deep dive into their financials. Make sure their revenue is growing over time. Their assets over liabilities are good. They have enough to pay down their debt. They are paying down debt, not taking an exorbitant amount of debt on. Free cash flow is what I like to look at. We want growing dividends, and free cash flow is what dividends are paid out of. So 2019, $10.3 billion. 2020, up to $13.4. 2021, up to $15.7. It will look like a drop in 2022 down to 13.4, but you can see here, this line item here, repurchase of capital stock, they bought back a bunch of their own shares. So that accounts for that drop. So overall, from 2019 to 2022, they are increasing free cash flow. And not only are they increasing their free cash flow, they are buying back their own shares. At least they did in 2022. I don't know if they are going to in 2023. I would love it if they did. And as you can see here at the bottom, I am long CVS. I currently have 120.888 shares. I am down 7.37%. I don't mind this. I want to continue to buy this, decrease my cost basis here, bring that $70.36 cost basis down while it's undervalued or under my cost basis, and increase my future return. This also increases my dividend yield. So CVS, that's the first one. Number 2 on the list is the monthly dividend payer here, monthly dividend company, Realty Income. Most every dividend growth investor out there likes this one, and I love it when it's under 60, and it is under 60. We're talking about Realty Income Corporation, ticker O. This is a REIT out of the real estate sector. Closed out the day August 31st at $56.04. I like this anytime it's under 60. Right? It is definitely under 60 now. 52-week range as low as $55.50. As high as $68.90. You're going to see a theme here. All of these are right up against their 52-week low, or pretty close, or headed towards that 52-week low. Market cap of $39.72 billion, a beta of 0.79, so another one that's less volatile than the overall market. Now, PE ratio is not a good one to look at. It is 41.82, very elevated. If it was PE was a good one, but you want to look at funds from operations for REITs. That's really the metric you want to look at that's equivalent to PE ratio for REITs. Earnings per share, EPS is $1.34 per share. Earnings date, the next one is October 31st through November 6th. Sometime in there, that's a big gap there. So sometime in that 7-day window, you should see their next earnings. Forward dividend is $3.07. They are a quarterly or a monthly payer, so you'd want to divide that by 12. They have a very nice dividend yield since they pulled back over 5%, 5.43%. Ex-dividend date, August 31st, so that would have been today. So if you didn't own them before today, and for ex-dividend, you want to own them the day before the ex-dividend date. So really, you want to, whatever you owned, if you own them, you want to count it on August 30th. If you were to buy them on August 31st, you would not get the dividend payout. They're going to pay on September 15th. And 1 year target estimate, at least according to Yahoo Finance, $68.08. So they see some upside appreciation in the stock price on this one as well. You can see they call it overvalued. They say about a negative 27% return. For this one, they see short-term, mid-term, and long-term. So they see it continuing to decrease in value, and it could potentially reach. Real estate in general is going to get hit hard, especially if they continue to raise their rates. A lot of these companies will be taking out additional debt here over the next couple of years, and no telling how high their new interest rate will be. Let's jump over and look at dividend yield theory. 5-year dividend average, 4.3%, sitting at 5.43, so definitely above their 5-year average. Another one that, according to dividend yield theory, is potentially undervalued. Payout ratio, very elevated, 224.70. This is one I am watching, but I'm still adding to it. I'm not as concerned. They are consistently elevated in their payout ratio. They return a lot of capital to their shareholders. Now, same thing on REITs. Return on equity, return on invested capital is going to look low, but you compare this to their industry average, a return on equity of 3, and a return on invested capital of 2.5. That's pretty much in line with a lot of their competitors. Some are doing better, some are doing worse. So not as concerned with these numbers not meeting what I want them to meet. Let's jump over and look at free cash flow under financials. 2019, $1.068 billion. They were buying back some shares back in 2019. They haven't bought back any shares in 2020, 21, or 22. But in 2020, they were up to $1.1 billion. 2021 up to 1.3, 2022 up to 2.56. So they are definitely growing their free cash flow from 2019 to 2022, over double what they were back in 2019. Very nice growth here on free cash flow. That is why I'm not concerned with this elevated payout ratio. They continue to increase their free cash flow over time, and they have no problem paying out their dividends. Again, I am long Realty Income. Again, these first four, you're going to see I have positions in. I have 146.531 shares. I am down 9.92%. Another one that in my cost base is $62.21. I'd like to get this under $60. So I'm going to continue to add to this one, decrease my cost basis, increase my yield, and increase my potential future return. And I'm looking forward to this $68 cost basis over the next year right here. So that is number 2. Number 3 on the list, Valet. And if you saw my most recent stock pick of the day video, you'll see this is one that I covered as well. We are talking about Valet SA, ticker VALE. This is a mining company out of the materials sector. Closed out the day August 31st at $13.17, down 1.2% on the day. 52-week range as low as $11.72, as high as $19.31. They consider this one undervalued with about a 10% estimated return if you were to buy it now, at least according to Yahoo Finance. Market cap of $56.851 billion, a beta of 0.81, so another one that was less volatile than the overall market. Very low PE on this one. Price to earnings at $5.42. Earnings per share, EPS, nice earnings per share on this one, $2.43. They do not have an earnings date listed. For dividend, they call it 69 cents. Actually, the next dividend paid out is going to be about 40 cents. I think they're including the previous payout on this one, but they do have a dividend yield on the year of about 5.21%. Ex-dividend date March 14th, and actually they just had an ex-dividend date go to, so this is a little, that's why I always recommend more than one source, because this is a little outdated information. They had a ex-dividend date in August. They will be paying out September 11th from that ex-dividend date, so this is not correct. And at least according to Yahoo Finance, they have a 1-year target estimate of $16.46. So they see some upside appreciation on this one. Again, if you were a trader, they have a price crossover, moving average, bullish. They see it going up in the short term, but mid and long term going back down. I'm not a trader, so I don't really look at the charts this way. But some of you out there that may be useful. Now, same thing. Let's jump over under statistics, go down to dividends and splits. We're going to look at dividend yield theory. Their 5-year average, not applicable. This is one that pays out semi-annually, typically twice a year, but their dividend is not a steady eddy, continual grower. They will fluctuate with the prices of iron ore and nickel, with the prices of metals. That is one of the downsides to investing into mining companies. Typically, they are at the whim of what the market value for the metals is. So if you're not into this kind of stock, completely understand. I don't mind the mining companies. I buy them whenever they're low, hold them whenever they run up in price. And they are cyclical in nature, so I am all right with that. Understand that if you're going to get into a company like this, there's going to be good times to buy them. My opinion right now is a good time to buy the mining sector overall. It's really pulled back, but then they will shoot up whenever the prices of metals jump up, which you'll see here down in the free cash flow. You can kind of see when that happened. Payout ratio is low, 44.8%. Again, they're going to pay out on September 11th. Return on equity, let's look at their financial efficiency, return on equity, and return on invested capital. I like 10% or better. Return on equity in this one, 53.4%, smoking high. Return on invested capital, 31.1%. Very, very high. Good numbers overall. Really, really like this company here. They're out of Brazil. Free cash flow, let's take a look under financials. 2019, 8.4 billion, 2020, 9.8 billion. Now this is what I was talking about. You'll see a huge jump up in 2021, 20.6 billion. And that metals really shot up in 2020, actually the end of 2020 into 2021. They've since dropped back, so you see this drop down in 2022. But I will show you here again on repurchase of capital stock. Huge purchase of stock in 2021 when they had this big jump up, and another big repurchase of their stock, 6.036 billion in 2021. So even though it looks like free cash flow from 2019 to 2022 has gone down, if you include the repurchase of this capital stock, it really has increased over that time. I am long Valet as well. Again, another one that I own in my portfolio, 230.314 shares. My cost basis is $13.71. I am down slightly, 3.7%. Another one that I'm going to continue to buy as it pulls back. I would love it to drop under $12 per share. I'm going to continue to decrease my cost basis, increase my future returns, and yield on this one as well. So that is number 3. And the last one, the fourth one that I own, this is the last one that I own. It's not the last one that I'm looking at for the month of September, but Enbridge. This is ticker EMB, out of the energy sector. Closed the day at 35.08%, down 5.51%. 52-week range as low as $33.96, as high as $43.04. So another one that's right up against its 52-week low here. They have an estimated fair value. It's 6% under its fair value by their estimate, at least according to Yahoo Finance. Market cap of $70.955 billion, a beta of 0.90, so less volatile than the overall market. PE ratio a little elevated on this one, $25.42. EPS, earnings per share, is sitting at $1.38. The next earnings date is November 2nd through November 6th, somewhere in that window there. Forward dividend is $2.63 paid out on the year. They are a quarterly payer. Nice, very nice dividend yield on this one, 7.46%. Ex-dividend date was August 14th. They are going to pay out on Friday, so I'm looking forward to that payout tomorrow. And they have a one-year target estimate, at least according to Yahoo Finance, at $43.02. And again, guys, I always recommend more than one source. So a lot of this information is coming from Yahoo Finance. This financial efficiency over here is coming from stockanalysis.com. So I do look at multiple sources to pull information from, and I recommend you do the same so that you can make sure the information that you are getting is accurate. And hey guys, thanks for watching. Don't forget to subscribe. Hit that subscribe button down below. And if you find any value in this content, hit that like button. Share with someone that you think that might find value, and drop a comment down below. Let me know what stocks you are watching for the month of September. What are you looking to buy? Do you own any of these companies? Again, these first 4 are in my portfolio. Do we own any of the same ones? I'd be interested to know that. Let's get back to the video here. Now let's jump under statistics, look at dividends and splits to look at the dividend yield theory here again. 5-year dividend average 6.60, current dividend 7.46, or over here forward annual dividend, same number, 7.46. So another one that according to, it's much higher. So according to dividend yield theory, is potentially undervalued here. Payout ratio, another one that's elevated. Not as concerned with this one either. They tend to be payout ratio higher than what you think they should be. 185.9%. This is actually down, believe it or not. It was over 200% here last month. So I don't pay attention a lot to this type of company, Enbridge. Again, you'd have to do some research on the company, why I say that, but not as concerned with the elevated payout ratio. Now let's look at return on equity and return on invested capital. Same thing, you'd want to compare this company to companies like Enterprise Product Partners, companies that transmit oil in natural gas. They also have their fingers in renewable energies as well. And the reason I don't worry about this payout ratio, they are doing a significant amount of investment in renewable energy projects. So they have a lot of money that is currently invested that they're going to be getting future returns on once those projects are in place. So this is a type of company, they do issue some shares. They use those shares to invest in a new project. So a lot of times their payout ratio will be elevated. That's why I'm not as concerned with that. Return on equity on this one, 6.1%. Return on invested capital, 4.7%. A little lower than I would like it to be, but not concerning. Let's jump over to their financials. Look at free cash flow, 2019, $3.7 billion. We're repurchasing some shares there as well. 2020, $4.1 billion. 2021, it's going to look like a drop down to $1.1 billion, but you'll see they're repurchasing a lot of shares. And 2022, $6.4 billion. So not only a big jump up, but also repurchasing more shares in 2022. So overall, 2019 to 2022, growing free cash flow as well as repurchasing shares over the last couple of years. Very nice to see. Another one that I am long in, 150.50 shares. My cost basis, $38.67. Another one that I'm looking to decrease my cost basis, increase my yield and my potential future return, down 9.29% on this one here. And this is number 5 and would also be a new position. This is not one that's currently in my portfolio. We are talking about Haverty's Furniture Company, ticker HVT. This is out of the consumer discretionary sector. Close out the day August 31st at $31.30, actually up on the day 0.77%. 52-week range as low as $24.79, as high as $38.85. So they are not quite up against their 52-week low. I would like them under 28 to start a position here, so they have a little bit more to drop, and that's what I'm hoping for. Now, this one is significantly undervalued, at least according to Yahoo Finance, at 98%. Now, I don't know if I buy that it's 98% undervalued, but they do see that it's consistently undervalued or very undervalued, and I would tend to agree on this one looking at the numbers overall. It is the smallest of the companies that we've looked at with a market cap of $512.841 million. It has a beta. It's also the most volatile, 1.37% or 1.37 on the beta, and price to earnings PE ratio very low, $7.26 per share. Very nice earnings per share at $4.31. Earnings date sometime between October 30th and November 3rd. Forward dividend is $1.20. They are a quarterly payer, and they have a very nice dividend yield at 3.86%. Ex-dividend date just past August 25th, so you would not be in line for the next dividend if you were to buy them now. It looks like they're going to pay out on September 13th. And according to Yahoo Finance, they have a one-year target estimate of $42, so they see significant upside appreciation on this one here. Now they see it have, this is what I'm hoping for, even though I'm not a trader, I am hoping that this is bearish and that in the short term it comes back down. And like I said, I'm interested at this one under $28 per share. So hoping for it to drop under that, actually. The cheaper, the better. Now let's jump under statistics. We're going to look at dividend yield theory. We look at the 5-year dividend average, 3.5. We compare it to its current 3.86. So that speaks to some undervaluation on this one as well. Everything we've looked at today is potentially undervalued, at least according to dividend yield theory. Very low payout ratio on this one, 26.45. So they, even though they have a high dividend yield at 3.86%, they have a lot of runway to continue increasing that payout over time. Now, return on equity and return on invested capital, again, I like 10% or better. This one is much higher than that, 24.7% return on equity, very nice. And return on invested capital sitting at 16.10, very, very nice numbers overall on this one. Let's jump under financials, look at their free cash flow. 2019, 46, that would be like 460,000. 2020, 46 million. 2020, 119 million. 2021, 63 million. 2022 looks like it's down to 22 million. But again, I'll show you the repurchase of capital stock, right? They're repurchasing every year their own shares. So overall, I would say if you added up the repurchase of shares from 2020 to 2019, they're probably about flat overall on free cash flow. But I do like that they are repurchasing shares. I like this one overall. Again, you'd want to get more into the financials of this one, but whenever I did a deep dive on this one, I really, really like the numbers and the forecasts on this one overall. So Haverty's is one I'm looking to add to the portfolio. It's not currently in my portfolio, but at the right price, it will make its way in. And if it drops under 28, I will certainly look to add it in September. Well, that is it for this one. Oh, as always, appreciate you stopping by. If you haven't done so already, don't forget to show me some love. Hit that thumbs up, ring the notification bell. Most importantly, subscribe to the channel. Join us here, the Vested Interest community, building a community of like-minded dividend growth investors so we can share our experiences. Stocks like the ones that I shared here that we're watching, looking to add to our portfolio. Stocks that we may be avoiding. We cannot benefit from each other's investing, but we can benefit from each other's experiences. And that's the idea behind this channel, sharing my experiences, good or bad, to help those out there become better investors. Or for those of you who may be scared about getting into the market, I am just, an average individual, grew up in a double wide trailer, do not have a degree or a background in investing. And if I can do it, I'm certain that you can do it as well. We are all going to make mistakes. Don't let making a mistake be a deterrent to you getting into investing. In my opinion, it is the only way to get out of the rat race, the best way to get out of the rat race. I prefer dividend growth investing, as I like the cash flow provided by the dividends paid out from the positions inside my portfolio. Let me know what you think down below with this video. Hit that like button, share with anyone you think that might find value. Drop me a comment. What stocks are you watching for September here? Definitely hit that subscribe button. It really does help out a small YouTube channel like myself. Hit that notification bell as well so you're notified whenever we drop any new content. I do personally read and respond to the comments. I'm always interested to read your questions, opinions, or suggestions for future topics. Excuse me. So if you have a stock you'd like me to cover in the Stock Pick of the Day series, go ahead and drop it down below and I'll work it into that video series. And this is Shane signing off, wishing peace and prosperity to you and yours. And remember, financial security comes to those who take a vested interest. Hey, thanks for stopping by, and we'll see you in the next one. I'm not a financial advisor. Nothing in this presentation should be considered financial advice. I'm only sharing my opinion and investing journey for educational and entertainment purposes. Investing involves risk. You can't money and should never invest any amount not comfortable losing. Always do your own research and invest based on your situation, circumstances, and select criteria, or seek the advice counsel of a certified financial advisor.